Welcome everyone to Scheller Lunchtime Live, a live stream series hosted by the Georgia Tech Scheller College of Business. My name is Lindsay Kane, and I'm the Associate Director of Client Relationships for non-degree executive education programs. On select Fridays at 12 p.m. Eastern, you'll have the chance to hear from Scheller faculty, student, and alumni speakers as they discuss relevant topics for the tech-driven digital age. At Scheller, we're proud to offer undergraduate, MBA, and PhD programs, along with open enrollment and custom executive education programs. It's my pleasure to introduce Alex Hsu, Associate Professor of Finance in the Scheller College of Business. He holds undergraduate and master's degrees from Brown University and earned his doctorate in finance from the University of Michigan. His research focuses on bond yields, equity returns, and macroeconomics. Alex builds theoretical models to examine the impact of monetary policy and fiscal policy on interest rate term structure. He also studies the empirical effects of government policy and legislation on firm outcomes such as returns and investment. He has presented at annual meetings of the American Finance Association, the Western Finance Association, and the Society of Financial Studies Cavalcade. He has given invited talks at the Federal Reserve Board and many regional reserve banks. His work includes accepted articles in the Review of Financial Studies and the Journal of Financial Economics. Today, Alex will discuss how the collapse in economic activity from COVID-19 affects equity valuation in the cross-section of firms and the channels that propagate and affect firm-level outcomes. As always, feel free to ask questions in the comments section. Alex will address as many questions as possible at the end of the session. Over to you, Alex.
Thank you, Lindsay, for the introduction and an invitation for this talk. I'm very happy to be here today to talk about COVID-19's impact on firm equity valuation. So this is the headline from the Wall Street Journal on March 10th, 2020, a little more than a year ago. It's hard to believe that we're still not out of it. At the beginning of March 2020, the severity of the pandemic is just setting in. The market reacted violently to the threat of the virus spread. And as you can see from this front page, some countries like Italy was already implementing the lockdown. Not only the stock market was crashing, oil prices cratered at the same time, and bond yields soared as investors rushed to hold safe treasury assets and trying to get out of stock holdings. So what was the policy response to the financial market turmoil? Here's the plot of the effective Fed funds rate in March of 2020. We started that month with the overnight interest rate at about 1.6%. Then on March 4th, the Fed had an emergency meeting to lower the rate to 1.1%. Just 10 days later, they realized how dire the situation was on the market and the economy and decided to drop the Fed funds rate to essentially zero on March 14th. All this is to show how impactful the global pandemic was on the financial market as a whole. By late March of 2020, stocks have declined roughly 40% in value. At the same time, I started to wonder about how the COVID crisis was affecting firms differently. Could it be the case that some firms are more impacted by the virus than others? If so, what are the channels through which this COVID crisis affect these firms? Finally, was the market crash the result of a fire sale that investors just trying to get away from equity holdings indiscriminately, or were firms more exposed to COVID risk punished more by investors? In other words, are the markets efficient? Eventually, my co-authors and I, including Peter Simisak, who's a graduating PhD student at Scheller, we wrote a paper that was published in the Review of Asset Pricing Studies last year to try to answer these questions. In that paper, we document that the pandemic affected firms differentially through its impact on labor supply and uncertainty. So economists are really quick in producing research on interesting questions. And the pandemic was a huge opportunity to study crises. One of the difficult tasks in economic research is to separate supply shocks and demand shocks. By the time we started to work on our project, there were already several working papers circulating, arguing that the pandemic was largely a negative demand shock on the economy. Here I have a very simple figure of the supply and demand curve that most of us are familiar with. And as we know, because price and quantity are determined jointly by supply and demand, it is very difficult to separate these two effects from one to another. While it is not difficult to see that the pandemic caused a significant decline in aggregate demand, which led to the market crash, I asked the question, what about the pandemic's impact on the supply side? Shouldn't the pandemic also affect workers and producers? This is a difficult empirical question, and it further motivated us to examine the cross-section of the firm returns as opposed to just the aggregate market. So what did we do in the study? Our sample period spans from January 1st, 2020 to March 26th, 2020, before the CARES Act was signed into law for COVID relief. And we collected return and corporate finance data on large national and multinational firms that are publicly traded. We then downloaded the COVID-19 case data, at the time tracked by New York Times, that is actually publicly available. The data set contains information at the county level on the date on which the 1st, the 10th, the 30th, and 100th case of COVID is reported in a particular county. Next, we match firm headquarter location to these counties by using the information that we collected on the firm side. Then we define this COVID shock to individual firms as the first reported case in a given county. So to put it simply, for UPS that is headquartered in Atlanta, Georgia, the COVID shock is the date on which the first case of COVID is reported in Fulton County, for example. The idea is we would compare returns of UPS after this COVID shock, or when the first case of COVID is reported, versus returns of UPS before the first case of COVID is reported. Of course, this is one example of an individual firm. In our study, we look at a panel of firms, across firms and across time. So this staggered introduction of COVID, and staggered, I mean the differential shock at the individual firm level. For example, firms headquartered in New York City are going to experience, or they experience this COVID shock before firms located, say, in Denver, Colorado. And this staggered introduction of the COVID shock allows us to identify the causal relationship between the spread of the virus and firm level equity returns. So here is a preview of our main findings following the COVID outbreak. So daily returns of public firms are 0.27% lower per day. So what do? We compare, we look at the 10-day window after the first case of COVID is reported in a particular county where the firm headquarters resides in. We compare those daily returns to the daily returns of the firm before the COVID shock, or the first case of COVID is reported. And we find that on average, the returns on the days in this 10-day window after the COVID shock is 0.27% lower compared to the days prior. Furthermore, we consider counties with high COVID infection rates How do we define high infection rates? We look at the counties where it took them much faster to reach 100 reported cases, or 100 or more reported cases. And then we compare the returns of firms residing in these high infection counties post the COVID shock to firms residing in low COVID infection counties, using this infection intensity, as we call it. And we find that the negative effect of the COVID-19 shock nearly doubles for these firms residing in high infection rate counties or high COVID intensity counties to the tune of about 50 basis points per day. So this is quite significant. And we conclude that the market appears to price the supply side too. So the argument here is, if you think about the staggered introduction of COVID shock to these individual firms, the argument would be that this localized effect that we document, it tells us that there's something about the supply of labor or capital to the firm that's causing the market to decline. Since these are large national and a lot of times multinational firms, it's hard to argue that the COVID-19 shock is hit in the county where the firm's headquarter resides in, and then something happens to their demand either nationally or internationally. So this gives us some evidence that likely this localized effect tells us that there's a supply side impact. To study the mechanism, we look at where the effects of COVID-19 on firm returns are mostly concentrated. Specifically, we look across firms and counties along the following dimensions. First, in terms of labor mobility, we look at firms located in counties with large change in increase in percent stay at home, using some measure that we get from the University of Maryland. Furthermore, we also examine firms that are more concerned with elevated business uncertainty. And the third dimension we examine are the firms with negative earnings revisions relative to their peers. So here is a map of firm headquarter location by county in our sample. As you can see, these are large publicly traded firms. Not surprisingly, most of them are concentrated in population centers such as New York or California and Florida. But as you can see, there's quite a bit of heterogeneity in terms of firm headquarter location. Obviously, there are a lot of firms located in the Midwest and the South as well. So to match this to our kind of county level COVID evolution data, here is the example. Here's the map of how COVID evolved in our sample. So this is the map showing the date when the first reported case of COVID happens in a particular county. The dark shaded area, the dark shaded county means they had COVID happen, the COVID report earlier, and then the light shaded counties have COVID report happen later. So for example, in the darkest red, such as New York, these counties had their first reported case of COVID prior to March 6th, 2020. Whereas on the lighter color side, the first reported case of COVID didn't happen until March 25th of 2020. Here's the first regression, our baseline regression that we run. So what we do is we have this panel of firm level returns, panel meaning across firm and across time. And we regress these firm level returns on these two COVID shock dummies. I have a dummy for the day when the case of COVID was reported. That is the dummy we call COVID 0. And then for the 10 days after the first case of COVID is reported, we'll have a dummy called post-COVID dummy. And then we regress the firm level returns on both the COVID zero dummy and the post-COVID dummy. And the coefficient loadings on these dummies tell us basically the differential return between the daily returns on these firms before and after the COVID shock. As you can see in this red box, that the coefficient loadings on the post-COVID dummy are all negative and statistically significant at the 5% level. So in samples, in columns 1 and 2, I'm looking at the full sample of firms. In column 1, I'm looking at raw returns. In column 2, we're looking at total returns, including dividend payments. And you can see in both cases, the firms return experience about a negative 0.27% decline on the days in the 10-day window after the COVID shock. When we move over to these high COVID intensity or rapid COVID growth counties, the effect is even stronger. In terms of column 3, looking at raw returns, we see that the daily return is about 50 basis points lower for these firms located in high COVID intensity counties. Here is our COVID intensity map again, shaded in green. The dark green denotes counties that has a very quick, rapid increase in COVID cases up to 100. And the lighter green denotes counties that has a slower COVID intensity. And then what we do is we separate firms located in high intensity counties and low intensity counties by kind of the medium intensity. And we use a dummy to denote firms located in these high intensity counties. Without running regressions, we just look at value-weighted returns of firms across in the cross section in the high intensity versus low intensity counties. And here is the event plot. So the red line in the middle denotes the first day, or the first day when the first case of COVID was reported. The red line denotes the value-weighted return, and the blue line of low intensity counties, and the blue line denotes value-weighted return in high intensity counties. As you can see, after the first case of low COVID is reported, firms located in high intensity counties earn much lower return compared to firms located in high COVID intensity, in low COVID intensity counties. So here's the study on the COVID transmission mechanism. What we're going to focus on, at least in this talk, is on labor supply and uncertainty. So we'll have some notion at the time that labor-intensive industries were hit hard by COVID. Here's a news headline about how coronavirus hits meat plants as some workers get sick, others stay home. So the idea is COVID shock arrives in the county, and workers decide that they're not going to go to work because they're afraid to get sick, or employers decide to keep the workers at home. This is all before state level lockdowns were implemented. Again, here is an event plot of COVID of labor intensity by industry. So the red line denotes firms located in non-labor intensive industries, and the blue line denotes firms in what we call labor-intensive industries. Again, you see after the event date, which is when the first reported case of COVID, the firms located in labor-intensive industries tend to earn lower returns relative to their counterparts in the non-labor-intensive industries. A simple regression study shows us the same thing. Here, we use a measure that we get from the University of Maryland COVID tracking project that gives us the change in labor mobility at the county level as measured by mobile phone usage in and out of the home. So in column 1 and 2, we use this measure of change in stay at home between 5 days prior to the COVID shock event to 10 days after the COVID shock event. And then we sort firms that are located in counties that experience the large or small change in labor mobility. And again, we put a dummy for these firms located in high decline in labor mobility using this ISH dummy. And when we regress the firm level returns on this post-COVID dummy interacted with this dummy that indicates a firm is located in a county that experienced a very large labor mobility decline. And as you can see, the coefficient loading on this interaction term is negative and statistically significant. Again, at the 5% level, this tells us that firms located in these counties that experience large decline in labor mobility, they also experience larger decline in returns relative to firms located in these counties with lower decrease in labor mobility. The second mechanism we look at is uncertainty. There's a large literature in economics that that shows that uncertainty can negative impact industries and economy significantly. There are many different mechanisms, but one of the popular ones that people have studied a lot is what we call wait and see. So when uncertainty goes up, firms tend not to invest and they tend not to hire people. When there's a large amount of uncertainty, they want to kind of wait it up. So here is a figure of GDP forecast dispersion of professional forecasters from basically 1970s to 2020, which was onset of the pandemic. And you see this very large spike at the very end, this between professional forecasters. And this is one measure of uncertainty. And this just goes to show you that uncertainty really increased quite dramatically at the beginning of the pandemic. Here, what we do is we use textual analysis of earnings calls using words similar to COVID and risk in some combination. So risk is another word for uncertainty as far as the literature is concerned. And we separate firms into that are concerned with COVID risk or COVID uncertainty versus those that are not as concerned with COVID risk and COVID uncertainty. And we put a dummy that we call I-risk to denote these firms that are particularly concerned with COVID uncertainty. And we run a regression of a panel regression of firm level returns. This post-COVID dummy interacted with my risk dummy. Again, these are firms that's more concerned with risk according to the earnings calls. And we see that in the full sample and in the high growth sample across the board, basically, you see that these firms that are more concerned with COVID risk, as described in the earnings calls, they tend to experience larger declines in returns on the days after the COVID shock is realized in the particular county where their headquarters resides. To conclude, COVID-19 impacts were quickly reflected in stock prices. Firms experiencing greater impact from a shortage of labor supply were hurt comparatively more. Firms more exposed to COVID uncertainty were punished more by investors. The one results that I did not show in this talk, but we dug into in the paper is that equity analysts revised expectations very quickly. And these firms that experienced large negative earnings forecast revisions tend to be punished more or have lower returns relative to their counterparts that didn't experience as large of earnings forecast revision. And broad government and fiscal monetary policy support at end of the sample, meaning end of March and April of 2020, likely alleviated some of these concerns. That's it. Thank you for tuning in. And I'm going to give this back to Lindsay.
Thanks, Alex. So a couple of questions. Today, the Wall Street Journal had an interesting article on German home buyers in the age of negative interest rates. How could this impact the U.S.?
That's, I guess, a broad economic question. So in Europe, some countries have negative interest rates, meaning home buyers are getting paid to borrow money to buy their homes. In terms of monetary policy in the U.S., as far as I can tell from all the statements from the Fed chair and governors, it's very unlikely that we're going to get into that situation where we're going to go into negative rates. I know that is something being talked about, especially during the 2008 financial crisis. Not as much after the pandemic, and I think that's a policy that the U.S. Central Bank is actively trying to resist in terms of going to negative territory. In terms of the spillover effects from Germany to U.S., that's an interesting question, but I can see in terms of sovereign debt investors, obviously they have less of an incentive to borrow, to buy bonds denominated and issued by the German government because they're earning negative interest rates, right? So that's going to direct some of the investors more toward U.S. Treasuries in that sense, which, despite all the stimulus packages we have enacted so far, according at least from the Treasury auctions, the demand seems still to be there for U.S. Treasury debt.
Well, and how has the U.S. market affected other countries?
U.S. Treasury market or the stock market?
Well, it just says U.S. market, so maybe a touch on both, if you don't mind.
Yeah, I think that was a pretty broad sell-off at the beginning of the pandemic, and but what we saw after our sample ended here, which is basically end of March 2020, there was actually some recovery in April and in May, and later on, again, hindsight is 2020. We didn't know this at the time. The market actually did quite well toward the second half of 2020. A lot of it, I think, it's again from kind of foreign investors thinking that if the world is not a safe place, the U.S. market, both the stock equity market and the treasury market, are still considered to be, the safest place or that they can go. And I think there's a lot of investment coming in to the U.S. market despite the pandemic, and also because this, again, the research on this is not as clear, but there's some notion that the monetary policy that the U.S. government has kind of implemented ever since the 2008 housing crisis has kind of buoyant the financial market, and that makes that makes investors more willing to kind of put their money in the United States.
And does the rising bond yield accurately reflect the inflation risk, and do equity prices fairly reflect this risk?
That is a complicated and very cutting-edge question. Everybody wants to know the answer, and people much smarter than me are actively working on a topic, and I myself as well. So there's some notion that the debt level in the United States is unsustainable in the long run. A very simple kind of present value discounting formula will tell you that the amount of real debt issued by a country should equal to the present value of discounted surpluses, real surpluses. And at the debt level we're at today, it's questionable. Again, when you're discounting something, there are two pieces, right? So there is the real surplus piece, and there's also the discount rate piece. And since these are unobserved and highly uncertain, there's a lot of debate on whether this present value, or what we call the government budget constraint, is going to continue to hold. So that's an active research area for especially for macroeconomists. In terms of inflation, we just haven't seen much inflation in this country for so long that I think even what some people don't realize is that the U.S. government has kind of slightly changed the monetary policy implementation in the last year since the 1980s, the Federal Reserve has kind of used inflation targeting as a way to control monetary policy. And the target is always 2%. We want to have about 2% inflation. Before the pandemic, the goal is the way the Fed would implement this is if we see inflation going up and approaching 2%, they're going to raise interest rates to kind of squash that down. What they have decided in the last year is they're going to let the economy run hotter than 2%. So they're okay with 3%. So they're not going to start raising rates until inflation actually hits 2% and above before they start raising rates. So inflation is still a concern, but not as much as let's say 20, 30 years ago, just because we really haven't seen that much inflation in the U.S. In the last 2 decades.
Well, thank you so much for your time today, Alex. Our next Scheller Lunchtime Live session is Friday, April 9th at 12 p.m. Eastern. The topic is how Pinterest is delivering inspiration in the time of COVID-19, featuring Scheller alumnus Ashish Ara. Ashish will share why social media needs positivity more than ever, learn why Pinterest prioritizes positivity, helps deliver inspiration, and why the travel industry is ready for a comeback. You can register for this event and learn more about future Scheller Lunchtime Live sessions by following the Georgia Tech Scheller College of Business on LinkedIn. A recording of this session and future sessions will be available on our LinkedIn and YouTube pages as well. Thank you all for joining.